Hi, this is John Hyre, and for a little while, I am answering questions for free and not behind the paywall that is my inner circle, which has a good deal more than just answering questions. And I say just answering questions because that normally would run you 1,500 an hour one-on-one. But let's get to it. I edited this question a little bit. Kevin had asked about deferred sales trusts. Those are a specific, weirdly enough, copyrighted, trademarked, I don't know which, but some sort of semi-proprietary thing out of Utah, which, as most of you know, if something's out of Utah or Nevada, it catches my attention and not in a good way. Now, I've had cause to look at deferred sales trusts, and there's now a lot written on them because they've been around for a while. I don't like them. We'll get into why in a minute. Their cousin, deferred income trusts, done by credible people for a much better price in a more conservative and careful manner, one that's not overdone on the fees, et cetera. Those have a use. So the question that I modified a little bit, deferred income trusts, and please no deferred sales trusts, a lot of upfront costs, helps delay capital gains. I've been approached about it, but I haven't done one yet. And so the implicit question is, John, what do you think about deferred income trusts? We had spent a lot of time covering this in detail. My Advanced Strategies Conference, which was both virtual and it was physically in Dallas this past May, I spent about half a day covering this. A lot of the time, how do topics come up for me for the inner circle? Because we do a topic every month. We've got topics in the archives. This was one of them. I'm interested in it. I've heard about it. I've heard it might save my clients money. I've heard it might be a ripoff. I've heard that it's just a new law and I should know about it. Clients or customers bring me ideas, whether they came up with them or heard about them, and then I go into them in detail. And I did that with I started with deferred sales trusts. And I wanted to get into the really nitty gritty, the details of the deferred sales trust, because I've heard so much about them. And again, the rough conclusion of my research, I don't like deferred sales trusts out of Utah. I don't recommend them. They're very aggressive. The fees are very greedy. The trustees for the trust cannot be gotten rid of, which I do not like. The trustee is in there permanently. They charge extremely high fees. And guess who the beneficiary of the trust is? The trustee. So these trustees, you pay a lot of money. When this trust's life runs out, who gets whatever's left? The trustee that sold you the trust. I don't like that at all. I really dislike that result. Furthermore, from what I've seen, and it's all anecdotal, because these guys are very secretive, but there are enough people out there who've done them. And over 30 years, I talked to a lot of people. They're very, very aggressive. And I am very aggressive, but I want to be aggressive, but really not cross any bad lines. And I'm not comfortable with some of the things I've heard that they've told clients they can do with these trusts. And again, it's hearsay. I've heard it from people who were approached or who actually use these trusts. And there were just some extremely aggressive techniques that I think really they were more counting on not getting caught than, oh, we can actually back this up in court. So like a lot of things out of Utah, for, by the way, very similar reasons, including insanely aggressive marketing that I just don't much care for. It's over the top, way, way over the top. The Utah, Nevada stuff, this is one of the ones I don't like for those reasons. Now, the kissing cousin, what's happened in the industry? People have started using the term deferred income trust so they don't cross that trademark, copyright, whatever the heck it is, barrier that the Utah people tried to set up. And so it's the same concept, much more inexpensive. I don't think I've ever seen a deferred income trust run more than a deferred sales trust in terms of pricing. I think more carefully and conservatively done. What is a deferred sales trust? It's basically an installment sale, and you're substituting a trust that you have some influence over. Not too much influence. If you have a lot of influence over a trust, we start to question, is the trust really a separate person? If the trust is not a separate person, that's very bad from an asset protection and standpoint, asset protection and taxation standpoint, given what we're trying to do here. So what does a deferred income trust do? You substitute a trust for a human. Let's say you're selling a bunch of rental properties and the buyer is willing to buy on payments, but you don't necessarily want to be at the hands of this buyer. For example, maybe you want to know for a fact that the payments are going to stretch out for, let's say, 30 years, and you're going to defer a lot of tax. You're going to set up a nice income flow, and this buyer could always prepay. Or maybe you're not so sure if the buyer knows what he's doing. Maybe you're worried, look, the buyer has the rental properties, but he's not going to run them the way I did. And maybe he's going to run them into the ground and he won't be able to pay me. So there are various reasons why you may not want the human buyer of an asset to be the person who holds the note. In other words, when you sell an installment sale, they're paying you, they're making payments. It's a note. You've lent them money, essentially. And there are times maybe that you look at the buyer and say, I don't know that that's a great idea. Or maybe the buyer doesn't want to do it. A lot of the times the buyer thinks, no, I can get really cheap bank financing, or I have a bunch of cash in hand. I'm not interested in seller financing. You can still substitute a trust in place of the buyer. You can substitute a trust in place of the buyer. You sell the property to the trust, let's just say on a 30-year balloon, interest-only payments. So you get income, you get big tax deferral for 30 years. The trust turns around and sells the property for cash to the buyer. The buyer's out of the picture now. The trust reinvests the cash in a way that you found acceptable when you formed the trust. Now, you don't have control directly anymore because there's a separate trustee. They're the ones who invest. But you have the ability to fire the trustee. You can't tell him what to do. You can make suggestions. And there is a line, there's a lot of law on how much suggestion can you make? When does a suggestion become an order? Because once it's an order, we start to break down the difference between you and the trust. And again, that has negative implications for tax and asset protection purposes. So view the trust as a substitute buyer for a property where you might not want a 30-year deferral. A lot of people like that. I've seen people do as short as 4 years on these trusts. They just want to spread out the brackets over 4 years and spread out the tax over 4 years. So it depends on what you need. But view the trust as a substitute human to whom you can sell assets and defer for a very long time taxes, maybe play tax bracket arbitrage over the years. For example, if you have a very low bracket year, there might be some payments, extra payments made to you from the trust. That's doable. So the trust is for deferring gains. And if it's a proper trust, you're going to put in the normal trust protections in it. You're going to use it for estate planning purposes. You want to have detailed provisions of what happens if you get hit by a bus, who are the beneficiaries, what do they get? It gets complicated. And that's, by the way, the downside of trusts. Somebody mentioned the expense in the first slide. Irrevocable trusts, when you give an asset to a trust that's irrevocable, that's permanent. It's not revocable. You can't get rid of it. You can't undo it. When you sell assets to an irrevocable trust, the assets are irretrievably in the trust, and you no longer own them. The trustee does, which is why trust agreements tend to be long, complicated, and expensive. You want to have a lot of care when you're dealing with what is this trust allowed to do. So you really have to be dealing with some pretty significant money in terms of gains. My personal opinion, I probably wouldn't bother with a deferred income trust for under $1 million in gain. I've seen people dip down to about 500 grand in gain. And if they can find a pretty economical version that serves their purposes, it might still be worthwhile. Certainly below that level of gain, I just don't see how it's worthwhile. So again, a deferred income trust, and there are so many varieties. I spent a half a day discussing what are some of the things you might put in the agreement? What are some of the things you really want in the agreement? What are things you might not want in the agreement? What are different use cases for a deferred income trust? And the name says the biggest use case. The reason you typically set one of these trusts up is what? You've got a bunch of income. For example, I'm going to sell a bunch of rental properties. I've decided I'm not going to 1031. I want them gone. I want to get into some other asset class I don't want to manage anymore, to name one example. I'm going to get rid of them. I haven't found an acceptable human to whom I'd like to sell, which kills my tax deferral. So I'm going to create a person, a trust. And I'm going to have that trust sell to the human that wants to buy. The trust gets the cash and invests the way I want it to. Why? Because I put it in the trust agreement from the beginning. And it's going to fund my lifestyle with that note. I sold to the trust on a note, in my example, a 30-year balloon, so a lot of deferral. with interest payments back to me. I have created a person, and in creating the person, when I made the document, I decided on the person, the trust's DNA, and how it's going to act. And given that I've got a lot of money in here, and I also want to defer the taxes, for me to be in control of its DNA is very important to me. That's what a deferred income trust is. So it's the same concept as a deferred sales trust. I just think the deferred income trusts have been a lot more reasonable and more likely to pass muster if audited. The details matter. One shout out, Todd Van Meter. This is a rarity. He is not a lawyer. I want you to know that. If you use him, you still need a lawyer who understands trusts to review and amend agreements. But Todd's an engineer and a real estate guy who decided to go explore this route. He didn't like the deferred sales trust. He had the same issues with them that I did. He went and paid a big shot law firm a good deal of money to figure this out. He wanted a deferred income trust. He paid someone to do it, paid quite a bit, and in engineer-like fashion, figured out all the details. And talking to him over the years, he really is quite knowledgeable on these sorts of things. So he is someone you might consult with. I think he's comparatively economic, but let's remember, he's not a lawyer. So if you're going to use him, he can make things more efficient. He knows what he's doing, but you must use a lawyer in addition to him. And it should be a lawyer versed in the state law, because trust law is very, very state dependent, and it's very variable depending on which state you're in. So you want to select a good jurisdiction. You want a lawyer familiar with that jurisdiction's trust law, because trust laws vary significantly from state to state. So I can't emphasize enough. I make a shout out to a credible man, but he's not a lawyer. And you want to make sure that you calculate that cost and don't get, I've seen a lot of investors and entrepreneurs use templates and not really pay to get good quality help. And that invariably backfires. If you've been in real estate for a while, for example, you know that the lowest bidder is almost never the cheapest bidder. They usually end up costing you over time. Same thing here. So for me, I usually would not look at a deferred income trust unless the gain we're deferring is going to be over $1 million. The only way I'd look at it for less than $1 million, maybe 500,000 or so, is if it's going to be a very simple deferral and hence a very simple trust. So there's the short version. Now I am going to take the presentation from Dallas, which is about half a day, and put that into the inner circle. As you know, I put a lot of subject matter, a lot of detailed presentations on all sorts of topics in there. And this is a topic that I could go on and on, not only could go on and on, but have gone on and on. So I'm going to put in there what we did in Dallas. I'm also probably going to update it because the Dallas presentation was live, and presenting in this format's a little bit different. So I don't think I need to update for content. It was a pretty recent presentation. I do think I need to update a bit for format. So those of you in the inner circle should look for that.